Hi everybody, this is AJ speaking. Today is September 12th. This is a Tesla trading performance update. We look at the key events, what was driving the stock. We also look at key themes that are driving the overall market, and then put Tesla's valuation into context. What I'm sharing today is my typical, or part of my typical subscriber content. Since I currently can't use X, I will be sharing this content temporarily widely. So just in a few days, my coverage should go back to normal, and then this content will be only available to my subscribers on X. So now let's dive right in. In front of you, you see Tesla's current trading in pre-market hours, so trading hasn't started yet. Stock currently trades at $370.94, and we will discuss in a moment why this is significant. But first, let's recap the key events as usual. So on this table, you see all the trading sessions. So the last full trading session was yesterday, Thursday, September 11. Tesla closed at $369. Stock was up 6%. That was a significant outperformance over the S&P 500 and also the tech index, Nasdaq. The indices performed plus 0.8% and plus 0.7% respectively. And if you beta adjust, you would expect a reaction from Tesla of around plus 2%. So there was about 400 basis points or 4 percentage points outperformance by Tesla. I think this was driven by a combination of factors. Elon gave a very bullish interview on the all-in pod. I think this also helped to motivate investors, but there were a number of other things. Tesla received another license to expand further its ride-hailing offering in the United States. Market significantly increased interest rate cut expectations, and we will be discussing this in quite a bit of detail in a moment. And as a net result, yields on the 10-year government bond, US government bond, came down to 4%. So the main driver was that we had at the end of last week a very bad jobs report, actually a long-term bad jobs report. Significant revisions to prior numbers showed that the US jobs market is in significantly worse shape than what was expected. The Bureau of Labor Statistics is currently under significant fire for putting out quite problematic numbers. By problematic, I mean they were significantly overstated. Then the second effect happened on Wednesday, the PPI, so the Purchasing Price Index, the Producer Price Index, which is viewed as a leading indicator of the CPIs, the Consumer Price Index, came in significantly below expectation. So the PPI headline number came in at 2.6%, expectation was at 3.3%, so there's a delta of 0.7%, or call it 70 basis points. That is very substantial. But then also the core PPI, that excludes some volatile items, came in at 2.8%, while it was expected at 3.5%. So economists got this quite wrong, and this actually is a continuation of overestimating inflation impacts. I think what the economists suffer from is the short-term bias. The short-term bias is something you can observe in economic forecasting, which results in the paradox effect that shorter-term forecasts tend to be more off than longer-term forecasts, which is completely counterintuitive. You would expect that periods that are closer would be better forecastable, but in fact, when you do a historical review of the best forecasts, or forecasts that are considered the gold standard or the best, you can see that forecasts that are further out tend to be more accurate than shorter-term forecasts. And the likely reason is that economists get too biased by current events, and therefore deviate too far from old and trusted scientific methods and inject too much subjectivity. And I think what we saw this year in especially US inflation forecasting is exactly that. Classically trained economists overestimated significantly the effects of tariffs, and the net result was a consistent pattern of overestimation. So basically, if we now combine all these factors, so what was driving now this significant change in market perception was basically the dual mandate of the Fed. So the Fed sets the interest rate, and their mandate is number one, to maximize jobs in US, but at the same time, their job is to ensure price stability, or the stability of the dollar. And the primary method is regulating the money supply. And a key instrument in regulating money supply is setting interest rates. And up until quite recently, it was assumed that the jobs market did quite well. And that took pressure from the Fed to focus on that part of their dual mandate and focus more on the second part, which is stability of the dollar. And because economic forecast is expected significantly more inflation, people assumed the Fed had less leeway to reduce interest rates, because it was assumed job market was fine based on the erroneously or the false numbers, and it was falsely expected too much inflation. Now we found out that it's the exact opposite. Job market is significantly weakening, and inflation is actually significantly less bad than widely expected, and that now basically flipped the discussion to now significant rate cuts, and we'll be looking at this in a moment. So let's now move on back to Tesla share price performance. So currently, today is Friday, stock is up this week, week to date 5.1%. This excludes the slight further positive performance in the pre-market right now to 370. So the stock opened, basically looking at the closing price Friday last week was $351, now to $369 is an additional 5.1%. This comes after last week's performance of 5.1%. That's quite good, but then there are a few other metrics we need to look at. Yesterday was a very strong day, 6% up. What's also positive is it came on quite strong trading performance. Yesterday's trading volume was $37 billion. And that trading performance is similar to last week Friday, which saw also quite strong performance in a negative market, I should point out. That performance was driven by the announcement of Elon's new compensation package. So Tesla currently benefiting from let's call it a continuation of a series of good news. So last week, Elon's comp package. Also Trump making positive comments towards Elon, apparently trying to mend the relationship. Then Elon's positive interview on the All-In pod, expansion of the ride-hailing network, significant improvement in interest outlook, i.e. lower interest rates, expectation of rate cuts. Then also importantly, you can see oil price here. And oil price is also supportive, stays at the low 60s, currently at $62. Oil price is very important for inflation outlook. And Tesla is still a company that is dependent on income from the auto business. Disproportionately benefits from lower interest rates, because lower interest rates make vehicle affordability or improve vehicle affordability. And that is always demand positive for an automaker, because most vehicle sales, new vehicle sales, involve some form of financing, whether it's in the form of a loan or a leasing contract. And lower interest rates meaningfully reduce the monthly payment a consumer sees, and studies have shown that is what a large share of the consumer mostly care about, even though economically this might not be the ideal view. Next, we look at share price trend relative to trading value. It is always something I pay a lot of attention to, because a significant rally on low volume is not that meaningful, and also vice versa. Should a stock sell off, but on low volume, is also not that meaningful. So it's always worth to keep an eye on trading volume. And what we saw is that the current rally, you can see this upward trend from, so that the red line is the share price from above 300. During most sessions was on, if you look at this trend, on significantly less volume. That overall is not positive. And we can see recently, so yesterday's trading was quite strong, but as I mentioned before, last week Friday was also quite strong. But you can see outside these, let's call it breaking news days, trading volume was rather low. And when we go back to Tuesday of this week, trading volume dropped to just 19 billion. That is quite low. Last week, Monday, after the holiday, was also quite low. This is roughly as low as it gets in Tesla's case. By all other company standards, almost, this would still be super high trading volume, but by Tesla standards, it's quite low actually. This actually makes me worried that the current rally on basically I'm lacking the words right now to describe it on just let's call it intangibles, is indicative that there's a risk that the stock is basically primed to pull back. When I look at news flow, what I think is, okay, is this net present value increasing? Yes or no? Does this change net present value of cash flows? Yes or no? And in my view is the things that fundamentally drove the stock recently, the expansion of the ride-hailing network, I think was a key item. Elon's comp package. I'm worried that they are not really changing the picture because, at least in my mind, this was the base case. Elon getting a new comp package was expected. Residual risk was priced out. Okay, that's fair point. But then also the ride-hailing expansion, I think, at least in my mind, this was the base case that every couple of weeks or a few months there would be an expansion. So that makes me slightly worried. So next, let's look at this sort of on a longer term perspective. What you see now is the absolute change, so in dollar per share on a weekly basis, starting from the first week of December of last year. So you see basically the last 9 months. So the current week is up $18. Last week was up $17. Prior week was down $6. The week before that week was up $9. So you see how this works. And then when we just look at the current level, so $370, that is actually the highest level, or we should actually use the $369 closing price. That's the highest closing price. If we compress everything down on a weekly closing basis, keep this in mind. This is the highest price in quite some time, basically since the sell-off in the first quarter of this year. But what does this all mean? For this, we look at what I call a share price corridor analysis. This is something I typically only share with subscribers, but as I said in the beginning of this video, because right now I can't post the next, I decided to share some of my research temporarily widely with everyone on YouTube. So people who are not familiar with this analysis, so what this does is it takes the observable multiple. So this is the next 12 months earnings outlook for Tesla and the share price from every trading session's perspective over the last 12 months, and then looks at what is the implied multiple. So what is the forward multiple each trading session? And then it looks at the median, so what is the most commonly occurring multiple, but then also at the standard deviation within 1 time standard deviation and 1.5 times standard deviation. So the 1 time standard deviation range plus and minus, so above and below the mean, is highlighted with the green lines, and the 1.5 times standard deviation is marked in the red lines. And the so within the 2 green lines, it shows you where the stock should be trading based on last 12 months implied multiple and earnings outlook from each trading session's perspective over the next 12 months. So this is forward looking. And you will notice this corridor seems to be fitting quite well over the last couple of months, but then is horribly off in prior years. For example, when you look back here, 2024, early on, 2023, etc. And that is by design, because that analysis only looks at the multiples implied over the last 12 months. So when you look at this period, we are right now here in September and highlighted by this blue line. You go back over the last 12 months. So it's this period, so this captures this the huge Trump victory rally where Tesla almost touched $490 per share, and then the huge trough earlier this year. So and then the let's call it calmer period over the last couple of months. So if you calculate the median multiple, this is what the midpoint of this range would show you. But because the multiple changed quite significantly, it's not something I'm going to cover in this video. If you apply this to prior periods and their respective next 12 months earnings outlook, you can see that the trading level has substantially increased. For example, again, this corridor marked by this gray shaded line, green and red lines, is based on the median multiple over the last 12 months applied on the current outlook. But if you apply that multiple to earnings, let's say here July 10th, 2023, to the next 12 months actual earnings delivered, the stock should have been in this area, but it was much lower. That tells you that the trading level significantly increased. So the bottom line is that based on current earnings outlook and also you can observe in the trading volume, there appears to be heightened risk for a pullback. But at the same time, you can also see during the recent Trump victory rally, which ended in December 2024, that the stock has always potential to get significantly out of range. But then, of course, also this analysis is based on the assumption that the earnings outlook is correct. And if you want to opine on whether my earnings outlook resembles reality or not, too bearish or too bullish, I recommend to read my deep dive report on Tesla. However, this is only available in my subscriber space, and this is something I posted a while back. And won't post this on YouTube because I expect that next week I will be back on X, and then I will stop sharing all the high value content with non-subscribers. I have to do it, unfortunately, this way because I have to make it worthwhile for my subscribers, and also it would be unfair to them if I would share all the high value content with all non-subscribers. Next, let's move on to interest rates, because that is really the topic that is driving the overall market. And Tesla is also significantly affected by interest rate outlook. So first, let me explain how this chart works. So the red horizontal line shows you the current level of interest rates. So it's in the 425 to 450 basis points, or you can call it 4.2 to 4.5% range. So that's the current level of interest rates. And this is shown here also on this axis. And then you have these additional horizontal dashed lines, and they represent where the interest rate level would be after 1 cut, 2 cuts, 3 cuts, 4 cuts, 5 cuts from today's 425 to 450 basis point level. Then down here, this thick gray line shows you the S&P 500. Actually, on this chart, there is no axis for the S&P 500. Is just an overlay to give you an easy comparison between the market performance and these curves. So what do these curves show? So these curves are based on basically the expectation of interest rate traders that can be derived mathematically from trading data. This data is provided on a daily basis from CME Group. This data historically predicted highly accurately shortly before an FOMC meeting the outcome, but several months out has seen cases where it was horribly wrong, so keep that in mind. But the next FOMC meeting, and you can see here these vertical lines show you actually the last FOMC meeting, which was on July 30, and then the next one is on September 17th, so only a few days away. And then the subsequent FOMC meeting is in October, and next one in December, and then thereafter, the first one in 2026 is in January. So this is what these vertical lines here highlight. And now let's go through these lines. What they show you is the expectation for the different meetings. So the next meeting is the one in a few days, so September 17th, and the gray line shows you how the expectation over time has moved relative to that meeting. So the way to read this is right now you can see the green line ends slightly below this horizontal dash line. This dash line means 100% probability of one cut on a probability weighted basis. That means right now, because the line is slightly below, it means that people on a volume weighted basis, let's call it, expect slightly more than one cut, but the Fed can't do 1.1 cuts. It's either no cut, 1 cut, 3 cut, 3 cut, 4 cuts, 5 cuts, and so on. But there's nothing in between. So basically, right now, this would imply that the market believes there will be 1 cut in the next meeting. And if you want to know what the expectation is for the next meeting, so the one in October, you then have to look at this blue line. So the blue line right now expects, from today's perspective, you can see this here, 2 cuts, because when you look at this, the blue line is the closest to this horizontal line, which signals 2 cuts. And then in the same way, you can look at these other lines, which belong to the other meetings. And so this light blue line that's the line for the December meeting, is closest to 3 cuts. And then the final meeting that's still captured on this time frame is the purple line. That's the meeting in January, and that is below 3 cuts. But right now, the interpretation would be that the market mostly assumes 3 cuts, not 4 cuts from today's perspective. And then the meeting thereafter, the next one would be in March 2026. It's not shown here on this chart anymore, but we can see here the expectation right now for that meeting. For that meeting, the market actually overwhelming or mostly assumes 4 cuts. So basically right now the market expects a number of cuts coming in relatively quick succession over the next couple of months. And lower interest rates are fundamentally good for the stock market. But you also have to keep in mind why expectation for rate cuts have increased so much. And it's because there's significant weakening in the job market. And historically, when people became quite euphoric about interest rate cuts, there is typically a point where then the discussion quickly then moves to the recession topic. So this is something investors should watch. And the other point investors should consider is right now, if the topic or the narrative was to move to recession, whether we get one or not, different topic. Given that we are right now trading at quite high implied valuations, S&P 500 is trading at well over 22 times forward earnings, unless forward earnings are off. That would suggest that the height from which the market can fall is slightly elevated right now. And just to substantiate the point I made earlier, that these expectations were quite correct in prior situations. They predicted correctly the ultimate FOMC rate decision in the final weeks before the meeting, but further out were completely off. And this is what this chart shows you. This chart shows you the how the expectation for a number of meetings developed over time. So, for example, the most recent meeting was the July meeting 2025. You can see the curve for this meeting is here. This call it brown line, and you can see the ultimate rate decision was no change. So this is this line here, this gray line, and it shows up here on this axis as the midpoint, which is 438 basis points. And you can see that, and the way to interpret this chart is when was the line closest to this gray line here at 438, and you can see that this brown line was only roundabout from May closest to that final rate decision, so only about, let's call it 2 months out, and they predicted correctly the final outcome. If you go back a few months earlier, 3 months out, market expected 1 cut, was wrong, there was no cut. And also when you go back to, for example, to last year, September, the market expected for the July 2025 FOMC meeting 6 rate cuts in July 2025. So in September 2024, market expected 6 rate cuts by July 2025. So you can see we're like completely off. However, what's interesting is that when we first got from the interest rates market first data, the market was basically almost on the money. They expected 1 cut, and this was 13 months out at that point. So that was actually not a good start. But then when you look at other data points, this probably was more like a fluke, because, for example, the January 2025 interest rate decision was also no change, and the market had, when that data first was released, and that was in December 2023, expected roughly at least 2 rate cuts. But long story short, I think this just confirms what I claimed earlier. Further out, the interest rates market are not a good predictor, but in the final weeks they tend to be quite accurate. Before I close this video, I just wanted to show you this slide. I didn't make this slide. This comes from JP Morgan Asset Management. This is updated as of end of August, so there's about 2 weeks of trading data missing. So the multiple in the market has moved up since. So the multiple right now is understated slightly, but they show you here S&P 500 trades at 22.2 times, and you can see by historical standards that is quite high. If you look at so this point right now, we held this point briefly earlier this year. Keep in mind, this is a very long time axis, so this goes back to 1994. So this was the let's call it the post-Trump victory rally high, and then of course the trough in April. Anyways, I would recommend to zoom out, and what you see, the key takeaways, and you can look at this gray line here. Over the last, you can see this is like long time, 30 years. The market only held this line during, let's call it 3-4 periods. There was a, let's call it prolonged, but I mean, the only time where this was significantly outperformed was during the dot-com bubble. It was this period where the market traded at one point above 24 times, and that never happened before. And then it took like a long time to get back there. And the last time we saw the market trade back to that level 22 times was during the COVID, let's call it money printing area, because this was really what it was. But you have to keep in mind the indebtedness of the United States and also many other economies was much lower back then. So to speculate on another free money area, I think is an aggressive assumption. So I don't want to sound too overly bearish, but I think it's always good to remember where the valuation is right now relative to a long historic context. So with that, I close this presentation. I hope this was helpful. To all my subscribers listening to this, I hope to be back on X next week. And since I can't share my content directly with you right now, I make it widely available on YouTube, so that at least there's some benefit, especially from this data that can go stale very quickly. Thank you very much for listening. See you next one. Bye.